This video is only for education purpose. For the next 2 minutes, imagine a world where investors believed the internet would reshape everything overnight. Companies with no profits, no real business models, and sometimes not even a product were suddenly valued higher than decades-old corporations. A tiny startup could add calm to its name and watch its stock price jump in a single day. Ordinary people quit their jobs to day trade from home. College students borrowed money to buy internet stocks. And long-term investing took a backseat as everyone chased the dream of becoming a millionaire in months, not years. But behind that excitement was a dangerous misunderstanding. Growth doesn't happen just because investors hope it will. Real value takes time, execution, and sustainable business models. What looked like the future of technology turned into one of the biggest stock market crashes in history. In this video, we will break down how the dot-com bubble formed, why tech stocks exploded, what triggered the collapse, how big companies survived while others disappeared, and what beginners can learn so this mistake is never repeated. By the end, you will understand not only what happened in 2000, but also how similar patterns appear in modern markets, and how long-term thinking protects investors from hype cycles. Welcome to Crypto Brain Power. This channel is all about teaching beginners how the stock market works, how historical events have shaped today's markets, and how long-term wealth building becomes easier when you understand the lessons of the past. Everything here is explained in a simple, practical, and educational way so you can learn without confusion. The dot-com bubble refers to the massive rise and sudden crash of internet-related technology stocks between 1995 and 2000. As the internet started becoming mainstream, many believed it would instantly transform business, shopping, communication, and global markets. That belief wasn't wrong. Technology was truly the future, but the timeline people imagined was unrealistic. Investors wanted fast results, and that desire created one of the biggest market bubbles ever seen. During the late 1990s, the Nasdaq index kept hitting new highs as investors poured money into companies with exciting ideas but very little revenue. Imagine a company today with no profits suddenly being valued higher than Apple or Tesla just because people believed it might become huge. That's exactly what was happening back then. Just adding the word internet could send a stock higher. Many beginners invested through platforms similar to today's Robinhood, using whatever trading tools were available at the time, without understanding the risks. Companies like Amazon were real businesses with long-term potential, but hundreds of others were simply built around hype. Many startups spent millions on advertising without earning anything in return. Some had offices, employees, and big plans, but no clear way to make money. Investors ignored financial fundamentals like revenue, cash flow, and sustainable growth because everyone thought technology could only rise. This type of thinking created a dangerous cycle. Prices kept going up, so more people bought in. The more people bought, the higher prices climbed. It felt like a guaranteed path to wealth, even though no investment is ever guaranteed. As with any bubble, the moment reality caught up, the market started cracking. By the year 2000, things began to shift. The Federal Reserve raised interest rates, making borrowing more expensive. Suddenly, companies that depended on borrowed money struggled. Investors also started questioning whether some internet businesses would ever make profits. Once confidence dropped even slightly, selling began. And once selling began, panic followed. Within months, the Nasdaq lost nearly half its value. Over the next few years, it would fall almost 80% from its peak. Companies that were once valued at billions completely disappeared. Some shut down overnight. Others declared bankruptcy. Well-known names at the time became worthless within weeks. People who invested their savings, hoping for quick gains, faced massive losses. Many beginners had put all their money into tech stocks, believing diversification wasn't necessary, which made the impact even worse. But not every company failed. Amazon survived by focusing on long-term business fundamentals, controlling costs, and building real customer value. Apple, though not an internet company, benefited from the long-term rise of technology and continued evolving. Even the companies that survived saw their stock prices fall dramatically, but they recovered by delivering real results over time. This shows an important lesson. Technology wasn't the problem, unrealistic expectations were. A common beginner mistake is chasing hype instead of understanding what a company actually does. Another mistake is assuming that a fast-growing industry guarantees fast-growing profits. The dot-com bubble teaches that even great ideas need time, patience, and solid business models. When people invest only because everyone else is excited, risk increases dramatically. Long-term investors who analyze fundamentals, diversify their portfolios, and avoid emotional decision-making are better protected during such cycles. As markets evolve, similar patterns appear. Sometimes new technologies, whether artificial intelligence, electric vehicles, or blockchain, attract massive attention, and some investors rush in without understanding the basics. This doesn't mean new technology is bad. It simply means timing, valuation, and realistic expectations matter. Markets go through cycles: excitement, overconfidence, correction, and recovery. Understanding history helps investors stay grounded. In today's market, platforms like Fidelity, Charles Schwab, and Robinhood make investing easier than ever. But convenience doesn't remove risk. The dot-com era reminds beginners to slow down, research companies properly, and avoid chasing every trend. Long-term wealth often comes from steady investing, not trying to predict the next big thing. The dot-com bubble remains one of the most important lessons in stock market history. It shows how excitement can create giant opportunities but also huge disappointments. The investors who learned from it became more disciplined and more patient. And those principles still apply today. If you enjoyed this breakdown and want to learn more about the evolution of markets and how history shapes the decisions we make today, subscribe for more educational videos. Educational purpose only, not financial advice.